back to our show. A lot of people do negotiate in order to try to get themselves into a better financial position. Otherwise, they just pay whatever it costs, right?
Right.
And most people actually want to accumulate some money throughout their lifetime. But what happens when it's all gone? When your life is all gone. And a lot of people maybe have to realize that no matter how well they negotiate their whole life, at some point in time, there's going to be some big choices to make. We are lucky enough to have Glen Thiessen with us with Transition Planning Inc., who helps families plan ahead for the major transitions in life with investment advice and securities through KMS Financial Services, Inc. Well, first, welcome back, Glen. How are you?
Thank you, Ben. It's good to be here. And how are you doing?
I'm great.
Good.
I'm stellar, man.
So you're doing well with negotiations?
I'm a negotiator. I am not a very good negotiator, I'll be honest. I'll tell everybody out there.
Well, the better a negotiator you are, the more wealth you'll probably end up with, right?
That's true.
So.
I'm more of how do we just get this done? Let's get it done.
Yeah.
That's my negotiation. I'd like to get it done. I'd like to move on.
We all like efficiency. That's right. So
the next person who's buying a house, or I buy a house, will be like, aha, we know this guy.
Yeah.
Glen, no matter how much money you have, something people do need to think about is, I guess, as you call it, legacy planning and estate planning. And you had an interesting question, which really I think is a really good precursor to a plan, which is no matter how much money you have, if you had to give everything away in 24 hours, what would you do with it?
Right. Where would you want it to go? Let's say that you could choose three different places. One would be charity, the next would be government, and the next would be like heirs, like family, right? So what percentage would you want to have go to each of those different places?
I'm going to assume the government comes in very, very low on most people's totem pole.
Most people would rather, have the government receive the least amount. What about charity and family?
I guess it just depends on how much you have. If I'm
Right.
Bill Gates rich, then it's probably charity.
Sure.
If I'm, me rich, I'll give it to my family.
There you go. See, the thing about charity is if you are wealthy and you've been successful and over your life you've accumulated a mass of wealth, and you did along the way have certain organizations or entities that were important to you, college, church, whatever, that you would like to see receive some of your wealth if there's more than enough for your family. The only way that that's going to happen is if you have a plan. Because without it written in your will or estate documents, it's not going to happen. See, because then you only have the two places, either the government and family. And basically, if the less planning you do, the more the government's going to get and the less your family's going to get. And whatever does go to your family, if you don't have a plan in place, is going to be eaten up by attorney fees, right? When you got family.
And you didn't even put that as one of my choices, attorney fees.
Oh, yeah. Well, I figured that would be really down there, below the government.
Below the government, that's right.
Yeah, so basically...
Poor lawyers, they do not get any slack, do they?
No. The butt end of jokes all the time. But there's basically only two plans available, right? There's the default plan, which is if you don't have a plan, the state has one for you. And then there's the design. And it's only by design that you can actually benefit charities that are important to you, benefit your family fully, and basically minimize how much might go to the government or attorneys. So what we're talking about is on a design plan, it's based around your desired outcome, based on who and what is important to you. So I just want to contrast the difference between estate planning and legacy planning because there's a huge difference. See, estate planning is really all about death, right? It's the event. But legacy planning is really about life planning. It's like what you do during your life. How are you going to be remembered as a person? Right, as your personality, like we were talking about during the break.
So
J.R.
like bronze
Ewing.
statues. And...
Oh yeah, well, some of the negotiators.
Or is this more like park benches?
Well, that too. I mean, but not too many people see that unless you're passing by and need to sit down, right? But the idea is, some people during their negotiating career, like J.R. Ewing, we were talking about with Dallas, back in the 80s. Some people in their negotiation process create this animosity toward themselves because of the personality that they exude, right? It's how do you want to be remembered while you're alive, while you're doing what you're doing, are you doing it well? Are you benefiting other people and yourself, right? So estate planning is tax-driven. How much estate tax can I get out of paying, basically? But legacy planning is all about values. It's what's important to you, and how do you benefit other people.
It sounds a little bit. I mean, estate planning is the how do we make sure our percentages are what we want.
Yes.
Family charity, a little bit to the government.
Right.
Legacy planning is the fun part.
Yes. Yes. As a matter of fact, it's like planning with the family instead of at the family. An estate plan, okay, here's my documents, go deal with it. Well, with legacy planning, it's like, okay, get together with the family, and how can we create a family legacy? See, it's more exciting. It's more involved.
So in one way, and I know this goes to business, but it'd be like being a Nordstrom. Like, we want to grow this business, and then a Nordstrom has a family legacy. Or maybe I think of like the families who own football teams or baseball teams.
Right.
And now I'm talking obviously huge, vast amounts of money.
Sure.
But to put it in scope, if you wanted to be a pillar of the sporting community in a certain city,
right,
that would be something you could do.
Exactly. Yeah, that's right.
I am in.
Good.
I will buy a sports team.
So, the other difference between estate planning and legacy planning is estate planning really focuses on the what and the how. What documents do I need? How does it need to be worded, and that kind of thing. But legacy planning is all about who. Who is it that you want to benefit, and why? What is it about that person or that entity that you want to be remembered for, and how do you benefit them? So every action, including inaction, is a choice with consequences. The thing you need to ask is 2 questions. Number 1, if you died tomorrow, how do you want to be remembered? Number 2, if you died tomorrow, how will others remember you? And if there is a difference between the answers there, then what is it that you need to do to change that?
Well, how do you figure out what the difference is in the answer? Because a lot of people's self-perception, and now we're getting a little bit beyond finance here.
Sure.
But a lot of people's self-perception is maybe different than other people's perception.
Yes. And the point that you just made is legacy planning is not all about wealth. It's not all about money or assets or things. It's about your personality, living on your legacy. How are you remembered? So it's more than money.
You know the book is a Dale Carnegie book, like How to Win Friends and Influence People?
Yeah.
I mean, it sounds like, and you tell me if I'm off here, but it sounds like, if you want to be remembered as a fun, friendly person, that's like a great book to read.
Yes.
You could walk around smiling at people, and, people will like you more, according, it's kind of a proven fact.
And it's how you do your negotiating. It's how you treat other people during your lifetime. That'll impact how you're remembered. So I have an assignment that can be very useful. If you made a chart on a piece of paper about all the significant events in each decade of your life and treat that as a chapter of your life story, right? In terms of personal, academic, professional, spiritual, community, and other achievements. So just basically say years 0 to 10 and so forth. Every decade is a chapter of your life. And then I'll take you up to today, where you're at today. Then what you want to do is map that out the rest of your way. What do you want the next chapters to look like? How do you want your life to play out?
There's the other strategy. You can also write your own obituary, which is another.
That's right.
A little more morbid, but similar thought.
That's right. That's right. And it makes it easier on your family if you've done that, basically. Right?
Keep it in the do not open until after file, right?
Yeah. The key is after you've mapped all this out, just meet with a professional or a team of professionals that can help you make it happen. So again, it's more than wealth. It's more than money. It's personality and how you want to be remembered.
Now, I think it goes so far in to helping people understand why they're doing things.
Yes.
And I think even brings back what David was talking about with buying a house. Like, of course, there's reasons you want to buy a house, and then there's financial reasons you may or may not.
Right.
But understanding those core values that you have as a person helps make all those decisions a lot easier.
That's right.
One thing we did talk about at the top, we do have to go to break in just a minute or so, but a lot of people don't want to give all their money to the government,
right,
which is always in the form of taxes.
Yeah.
You are back with your tax minute.
Yeah.
Help us understand some year-end tips.
You are at the end of the year here. You want to sell poor investments to offset gains on other investments, plus up to $3,000 of income. You want to use up capital losses carried over from previous years by taking gains on investments before the end of the year. But you got to watch out for the wash sale rule, which means that if you buy the identical securities within 30 days before or after the sale, then even if that's in a different account, then the loss is not deductible. Instead, it's disallowed. The disallowed loss is added to the basis of the new shares. So if you expect to owe the IRS a lot of money when you file your taxes next year, you want to increase your tax withholding from your December paychecks or your IRA distributions, and you can avoid the underpayment penalty if you either prepay 90% of your 2012 taxes due or prepay 100% of your 2011 tax liability, or if your income was over $150,000, prepay 110% of your 2011 tax liability.
Now, to understand exactly where you are, obviously they can contact you, and they can find you at, on our Facebook page at facebook.com/Brashonomics.
Yes.
Glenn, always a pleasure. We do have to go to break.
Okay.
Stick around for a few minutes. David Bell, Matthew Royal, and of course Glen Thiessen are coming right back.